So what I'm going to start by doing is just sharing this screen over here because this should kind of show you what's happened, right? Like we started with this charting in towards the end of the year, and it popped up after the election, and it seems like it's kind of just gone straight down after that. And a lot of people look at this and they think, man, that's a big downturn in the market. I'm not used to that. And it scares me. What should I do? And I get it. I get it. Psychologically, we all know this. Loss is way more impactful than gain. So as your accounts are going up and everything's okay, you don't really feel it. And unfortunately, you don't really enjoy it as much as you do when you feel and don't enjoy when the markets go down. So you look at this chart and you think, man, this is rapid. I wasn't expecting this. And then I back it off and I actually tell you that this was 2024. So if you look back from just let's just say 2016 to 2025, and you were to go through these market movements that look like this area right here, you could see this happen in the last 9 years, 7 times. And that's just on a once a year occurrence. That does not include COVID. It does not include 2019, which was pretty rough too, by the way. I know a lot of people forgot about that, but it was really bad. Um, but you look at this, and I try to kind of bring back that perspective because in 2024, July through August was actually way worse than what we're looking at today. And I mean that statistically and percentage wise, the market went down far more just last year than it already has this year. But it recovered. And we know that at the end of last year, most people's portfolios did really well. And then you back up to 2023. Well, what happened then, right? We were going through this inflation is transitory speech that happened at the end of 2022, and 23 rolls around, and then all of a sudden we have to start looking at this inflation's not going away, which is odd because it really started to go away about the time you see this chart over here that says the market went down. So when we look at inflation and we look at the markets and we look at tariffs and everything, I just wanted to provide the perspective that this is actually pretty normal. 10% happens once every 14 months on average. 20% happens every 49 months on average. 30% just about every 7.5 years. And they're not fun. But the reward is if you know the history and you know your physical connotation in terms of the way you're going to react, at least you know that's there. So when the market goes down and you feel that loss, you can try to remind yourself, hey, psychologically, I feel this way more than I do when the market goes up. And I also want to, speaking of, being there before, this next window, created this chart a couple weeks ago because I had a lot of people asking about tariffs. And I told them, and you, we've been here before. It's not fun. I don't like it. I don't like tariffs in the way that they're being used now. I told somebody a couple weeks ago, believe it or not all tariffs are bad. Some tariffs are more required. And it's kind of wild to think that way, but there are some countries that have populations of maybe 300,000 people. But to make sure that their inventory is stable for their own citizens, sometimes they will enact tariffs to make sure that their people can actually have some of the inventory of the things they created. Those are called outflow tariffs. They don't want to sell too much. They don't want the companies in their country to sell too much out because they want to be able to afford it, but also to be able to afford some of the products to make sure that they're maybe not too abundant. They'll put a tariff on incoming goods that they maybe also produce. So, from what a small country tariff perspective, not a bad thing. From a big company tariff perspective, you really have to be careful. And it sounds cool to say, we're bringing in tens of billions of dollars. And by the way, not a political statement, but it really can cause harm to what has been trying to be fixed over the last 3 years, which is inflation. But I bring this chart up to show people, believe it or not, 2017, tariffs were a thing too. The communication about tariffs was happening right after January, whenever the inception of presidency in 2017, based on the 16 elections. and tariffs were communicated. Were they enacted? Some. Did they stick around? Not very long. As a matter of fact, most of the tariffs averaged about a 78-day term. And you can see this based on the tariffs that actually went down here. And what did that do to the market? Well, we're seeing it again, almost a play by play of 2017. Tariffs went up, market went down. Tariffs went down, market went up. And it didn't just kind of go up, it went up fast. And the real easy and simple way to consider this is if tariffs are bringing the market down and they disappear, they're no longer there. As long as they weren't there for a long time, it's okay. And I don't mean to minimize it. I don't mean to say that they're a good thing. I just mean to say that most of it is what we call pulpit bullying, just kind of going through and making sure that you get your way or you don't get your way. And it's more of a leverage tactic than it is a financial tactic. But the chart hopefully provides some context to show you this is not new. What are we dealing with right now, though? What's bad about the market? Debt. Debt is really bad. As a matter of fact, consumer debt's the worst it's been in about 25 years. But you'll hear that on the news. I'd like to bring it into a little more focus. The type of debt is what's concerning. So 3 years ago, mortgage debt, total debt, auto loan were a big topic because people were worried that housing was unaffordable. It was, and it's worse today. However, we've kind of done it to ourselves. Because once we got into these low rate home environments, we all of a sudden found this extra cash flow. And what do we do with extra cash flow as Americans? We spend it and we leverage it. We leverage ourselves. People started using credit cards far more. And credit card debt has reached a point where, to me, it's about maxed. And that means that the retail therapy stocks, the companies that people would enjoy, some of the travel even, has seen its heyday and it's kind of subdued for a while. So where you won't see growth in retail and travel stocks and some of the ancillary companies that people want but they don't need, that's going to be gone for a while. I don't think I'm saying years, but I'm saying at least a year until interest rates start to come back down and people's credit card payments come down with that. Now, on top of that, the more scary thing is home equity lines of credit have been over leveraged. A lot of that has been from cash out refinances when people 3 years ago got those low rates, they took some cash out. More often, though, in the last couple years, it's been from people taking money out because they need it. Not a great thing. What that has resulted in is over leveraged debt from consumers in the market. And the one that I've focused on for 3 years now, and I actually thought it would be a problem prior to today, but it is now, auto loans. If you look at the largest auto loan distributor, it's Huntington Bank, and people are not paying their loans. It's the highest percentage of car loan in terms of 2 months missed payments that we've had in 27 years. And that doesn't sound like a big thing, but it's an indicator, right? If people can't pay their car payment, what's next? What other payment can they not make? And it tends to go in order of necessity, right? I need my car. What's the next payment that people really need after that is unfortunately their home payment. And with those home equity lines of credit being over leveraged on top of that, it's really caused some issues. So that's one of the bad things. I'm going to jump to probably the next bad thing about the market, which is GDP. If you look back at this, it's a fairly steady chart with the exception of here. That's COVID. I kind of just like take COVID and put it over here to the side because those numbers are kind of like social media. They're just not real. It's not real life. And it does have an impact on the spending that came after. But let's just take these two out for a second. If you look at GDP after that, it flew up. It went up really fast. And a lot of people saw that as we're recovered, we're great, this is awesome. But the reason and the rationale as behind why it went up is really the reason we're in the issues we're in now. It is not a political statement for me to say that the government spent way too much money in 21 in 2020 to the tunes of trillions of dollars. The debt was quadrupled. The deficit spending was far worse than that. And I say this as kind of a reminder here, too. You hear these on the news, and I want you to be really attuned to the difference between these. Debt is a total, which we're standing at about $33.6 trillion today. Unfortunately, it's going to go up by $1 trillion every 112 days, purely based on interest. The second thing is deficit. Deficit is the difference between what we make and what we spend. Think of this from a family level. You have to budget your checkbook. Our government doesn't budget their checkbook, they just make more money. Well, when you make more money, you have to have something to back it. How do you pay the money back? That comes from the Treasury or the Federal Reserve. Now, imagine for a minute you had this magical power to create a commodity, a metal, a precious jewel, and you could use it to back up a currency. In your mind, wouldn't it be wonderful if you could just create a lot of currency to go buy a lot of things? The adverse effect of that is as you create more of these jewels to back your currency, the value of those jewels goes down because there's more available. And that's exactly what's happened to the Federal Reserve, the Treasury market, and the US debt. The Federal Reserve had to back all this money that was spent during COVID and the year after, and up until today, quite frankly. And every year they're having to create enough treasuries, enough US bonds to back the spending that the government does. Well, when you go from creating $400 billion worth of treasuries to 1.3 trillion in 1 year, and then you duplicate it for 4 years after that, you create that surplus of jewels, which minimizes the value. And we felt that in 23 when everybody's stock portfolio went down, but more importantly, 22 when our bond portfolio went down alongside of it. That's supposed to protect our portfolios, but it can't when there's a surplus. So government spending has to come down, and when it does, GDP will come down too. Not a good thing, could lend to a recession. Probably necessary that the government stop spending the way they are, or we're going to be in a little bit of trouble. That's just the kind of the facts. If you look at the CPI, inflation index, not bad. Tariffs could disrupt that. We have to be very careful and watch out for that. But inflation's back down to about 2.5%. Realistically, if you look back, and I kind of remind people of this, it wasn't that far off post-COVID. And really, 2% is kind of always the goal. That's that not too high, not too low. We can adjust for and calculate for that level of inflation. But anything above 3 starts to feel worse in your pocketbooks. You actually start to feel that. Well, we got up to 9 plus 2 years ago. We're back down to 2.5. You will start to see the Federal Reserve lower rates, but not because of that. If you hear that they're lowering rates because inflation's down, you should ask yourself why they didn't do it already. And the answer is, I have no idea. The only caveat I have to that is they're probably worried about tariffs too, because if that causes inflation and they've lowered rates, that could be harmful. When you look at inflation data and the way it's going down, when they inevitably lower those rates, it's not because of inflation, it's because of what I just spoke about. That government debt. Remember, I said just about every 100 days, we got another $1 trillion added to the debt just from interest, which, by the way, our government spending per year is about 1.4 trillion. So we're actually doubling that deficit because the interest is so high. So the Federal Reserve at some point is going to have to lower that back down. And that's another reason we didn't see government debt really fly up until interest rates went up, because if you're paying 0% on a loan, your debt's not going to go up. But when you start to pay 5.5%, it does. So we've got to see that start to come down in the next year. I'm betting that we will, probably 3 to 4 times. Last thing I'm going to talk about is employment. Over the last 3 years, we have created a lot of jobs. Last year, it was more even. It was more healthcare and education. The year before that, though, and the year before that, 85% of the new jobs were government jobs. Not a bad thing all the time, but not sustainable over a long time. When people have government jobs that are put in place and it's government spending to pay for the jobs, that kind of goes back to that same issue of deficit spending. It's not sustainable. So you're starting to see that unravel now with the new administration, where they're starting to freeze hiring, end contracts. Look, unfortunately, for a lot of people, they're losing their jobs because of this, but it's one of those things that you look at and say, it's fine if the private sector jobs are there. They're not. Hiring is actually down. The job cycle is not there. And that's the biggest reason that a lot of people are looking at this and saying our GDP is going to be negative. Real quickly, employment, the COVID, let's kind of stack that to the side a second. If you look at this chart, you kind of draw a line. It's on a pretty normal trajectory. But anytime you have exponential spending and quick change like this, it does disrupt the economy. Last but not least, at the beginning of January, these banks and these institutions told us that through the end of this year, the market was going to go up. Every company, every analyst. And now those same analysts, those same people, 3 months later, are starting to change their tune. I want to tell you something. If an analyst went through the election last year and are starting to see things that they didn't expect to see, they're not a very good analyst. Everybody knew that this was going to be conjecture. Everybody knew that the changes being made right now were going to happen because that's all they talked about during the election cycle. None of this should be a surprise. But I want to fine tune this a little more and start talking about the analytics from the top down. When you look at these researches, most of these haven't changed, and most people still think the market's going to come back up. I am one of those people. And it's not because I'm constantly positive. It's because of the thing that I tell people most. When you start to hear the word recession, it's almost over. Most recession reportings happen towards the end of it because you don't get the data until 6 to 9 months later. And I do think we're probably going to see recession-like activity. I don't think it's going to be long-lasting. And what that could lead to is if you start to see jobs change, interest rates come down, consumer debt come down because of that, that could lead to excess spending again. And if you see tariffs that are right now being used as a leverage play go away, that helps with price balancing. Last thing, and then I'm opening up for questions. The index of inflation for the last year, year and a half has been wild to me because there's different kinds of inflation, but what's the one thing people keep talking about when they hear about inflation? Eggs. And let me tell you something. It has nothing to do with inflation. It has nothing to do with anything we've talked about today, yet people keep talking about eggs. Why? I'm going to tell you. Government people love to have gotchas. And 18 months ago, our last president had a really difficult decision. He had to cull chickens or risk flu spreading. Now, a lot of people would tell you, you cook the eggs, you're fine. Maybe. I don't know the science behind that, but he was in a no-win situation because if he didn't cull the chickens and then we had an outbreak, looks terrible. Culls the chickens, by the way, well over 1 million chickens. I think it was about 1.5 million chickens. Well, I don't know about you all. I don't buy eggs at the store. I've got farm eggs, and my chickens produce lots of eggs. People's chickens are pumping them out. You do 1.5 million chickens, and you multiply that times the times of eggs that they put out a week, and that goes away. Guess what? Cost is going to go up. Does that have anything to do with inflation? Not at all. So when you see prices coming back down now, it's because of two things. The new administration put $1 billion into what they would call bioconservative efforts to make sure that flu outbreaks weren't a thing. That's good. Make sure we don't have flu outbreaks. Cool. The other thing is they started importing eggs. They brought the inventory back up. They started pulling eggs from other countries. Some of the countries were charging tariffs to, which is kind of weird. But it has helped with the egg prices, and it will continue to do so. Same thing with gas, same thing with eggs. Nothing to do with the inflation otherwise. If you take those out, you look at groceries, gas, normal spending, travel, that is because of excess cash and capital, because of low rates, which now is getting us in trouble as rates go high.